Most people who earn a middle-class income will make over $2 million in their working lifetime and retire with almost nothing because they never learned the difference between earning money and keeping it. That gap between what flows in and what stays is the only number that determines whether you end up stable or scrambling. Not your salary. Not your job title. Not the car in your driveway. The gap. And almost nobody tracks it, because tracking it would mean confronting something uncomfortable, that the life you're living might be quietly draining you dry. The first rule is the one nobody wants to hear, which is why it works. You have to pay yourself before you pay anyone else, and you have to do it the moment money hits your account, not at the end of the month with whatever's left. Because here's the thing about whatever's left, it's always close to zero. That's not bad luck. That's Parkinson's law applied to money. Expenses expand to consume whatever income is available. Every single time. The only way to beat it is to remove the money before your brain gets a chance to allocate it to something you won't remember buying 3 weeks from now. The amount matters less than the automation. Even a small percentage moved instantly into a separate account changes the entire structure of how you spend. You stop spending from abundance and start spending from what remains, and your brain adapts usually within 2 months without any feeling of sacrifice. Behavioral researchers have documented this over and over again. People who automate savings first report the same quality of life as before. They just can't explain where the waste used to go. Second rule, your housing cost is either building your stability or silently destroying it, and there is no middle ground. When more than 30% of your take-home income goes to keeping a roof over your head, every other financial goal starts suffocating. Emergency fund? Slower. Investing? Delayed. Debt payoff? Barely moving. Housing is the single largest lever in most people's budgets, and it's the one they set once and then forget about for years, even when their income changes, even when their city changes, even when their life changes. The people who stay financially stable tend to do something that looks boring from the outside. They keep their housing costs locked well below what they could technically afford. The bank says you qualify for a bigger place. The listings say you deserve more space. The math says something different. The math says every dollar not absorbed by rent or a mortgage is a dollar that can go to work for you somewhere else. And dollars that go to work don't come back alone. Third rule, and this one separates the people who build wealth from the people who just look like they're building wealth. Never finance depreciating assets longer than their useful life. A 5-year loan on something that loses half its value in 3 years means you're still paying for something that's already working against you. This is how people end up underwater, not because they bought something expensive, but because they stretched the payments so far into the future that the debt outlived the value. This shows up most brutally with vehicles. The average car payment now runs somewhere around $700 a month for 6 or 7 years. That's not a payment, that's a second rent. And unlike rent, it's buying you something that's worth less every single month you own it. Financially stable people tend to drive vehicles that cost them the least per month in total. Purchase, insurance, maintenance, fuel, not the ones that cost the least to finance. Those are two completely different calculations, and confusing them is one of the most expensive mistakes in personal finance. Fourth rule, every dollar you spend has an invisible price tag attached to it, the future value of that dollar if you hadn't spent it. This is opportunity cost, and it's the concept that changes how stable people think about money. A $50 dinner out isn't $50. Invested over 25 years at a historically average market return, that $50 would have grown to roughly $340. You didn't spend $50, you spent $340. You just won't feel it for decades. This doesn't mean never spend money. That's a miserable way to live, and it doesn't work long-term anyway. What it means is that financially stable people have a filter running in the background. Is this purchase worth its future cost? Sometimes the answer is absolutely yes. A meal with someone you love, an experience that matters, a tool that makes your work better. But a subscription you forgot you had? A delivery order you placed because you were bored? An upgrade you bought because it was on sale? Those have future costs too, and they add up into a number that would genuinely disturb most people if they saw it calculated out. Fifth rule: an emergency fund isn't optional, and it isn't aspirational. It's the foundation everything else sits on. Without 3 to 6 months of essential expenses in liquid, accessible cash, every unexpected cost becomes a crisis. And crises are expensive. They force you into high-interest debt, late fees, overdraft charges, and desperate decisions. The emergency fund doesn't earn you money. It saves you from losing money at the worst possible moment. Research consistently shows that households with even a small cash buffer, even 1 month of expenses, experience dramatically less financial stress and are significantly less likely to fall into debt spirals after a job loss or medical event. The biggest mistake people make with emergency funds is treating them as a goal to hit later. Later doesn't come. What comes instead is the emergency, and it always arrives before you plan for it. Stable people build the buffer first, before investing, before extra debt payments, before lifestyle upgrades, because they understand that without it, every other financial move is built on sand. Sixth rule: debt has a hierarchy, and ignoring that hierarchy costs real money. Not all debt is created equal. High-interest consumer debt, the kind that charges 15 or 20% annually, is an emergency. It compounds against you with the same mathematical force that investments compound for you, but faster, because the rates are higher. Carrying a balance on high-interest debt while simultaneously trying to invest is like filling a bathtub with the drain open. The math doesn't work. It will never work. Stable people treat high-interest debt the way they'd treat a fire in their kitchen, as the most urgent thing in the room. Everything else waits. And once it's gone, the cash flow it was consuming becomes available for building, not just surviving. That shift from paying interest to earning returns is the single most powerful inflection point in most people's financial lives, and most people delay it by years because minimum payments feel manageable, even though manageable is just another word for slow and expensive. Seventh rule, and this one is emotional, not mathematical: stop comparing your financial life to what other people show you. Comparison spending is the single fastest way to destabilize a budget that otherwise works. And it's accelerating, because the version of other people's lives you see is curated, filtered, and almost always financed. That colleague with the new car? Probably 60 months of payments. That friend who just renovated their kitchen? Possibly a home equity line they'll be paying off for a decade. You're not comparing your finances to theirs. You're comparing your reality to their debt. Financially stable people develop something that researchers call financial identity, a clear internal sense of what enough looks like for them, independent of what the people around them are doing. This isn't natural. It has to be built deliberately, because the human brain is wired for social comparison. It takes conscious effort to override that wiring, but the people who do it consistently report something that sounds almost too simple to be true. They stop wanting things they never actually needed. Eighth rule: your income is not your wealth. Your wealth is what remains after your lifestyle is subtracted. Two people earning the same salary can have wildly different financial outcomes 10 years later, and the only variable is the percentage they kept. The savings rate is the single most predictive factor in long-term financial stability, more than income level, more than investment returns, more than financial literacy scores. Someone saving 20% of a modest income will almost always outperform someone saving 5% of a high income, given enough time. This is the part that makes people uncomfortable, because it means the problem isn't usually that you don't earn enough. It's that the gap between what you earn and what you spend hasn't been protected. And protecting that gap requires something that no spreadsheet can give you. It requires deciding, once, that your future self matters as much as your present self. Not more, just as much. That's the real division. Not rich and poor. Not lucky and unlucky. It's the people who built systems that protect the gap, and the people who kept meaning to. The rules aren't complicated. They never were. The hard part was always just starting, and the people who start tend to stay. If this changed even one number in your head, subscribing takes a second, and it helps this channel keep making content that actually matters.